And the US stock market just had its greatest week in over a year. But worries about corporate America's earnings prospects remain just below the surface. The outlook for more companies are lower than expectations of the experts this earnings season. Bloomberg data shows only once since 2019 has a forward guidance measure that compares company estimates with the Wall Street consensus, which has been lower. Stock market bulls could see that as a hint. The C-suite signals are being overly cautious, paving the way for eventual investor jubilation. However, a pessimistic reading suggests that businesses are discreetly strengthening their reserves in the face of an uncertain global outlook. What adds to worries are the headwinds brought on by the Federal Reserve's rapid interest rate hikes. Well, about a quarter of S&P 500 businesses, mostly in the technology and other industries, provide quarterly guidance. Most of the big tech companies have reported earnings in line with or even better than the forecast or the expectations. But optimism has been dampened by generally higher borrowing costs. Weaker than expected US employment data on Friday, which supported expectations, and the Fed is done tightening. That sent Treasury rates down and the S&P 500 higher by nearly 6% for this week. But Bloomberg data shows the ratio of raised to lowered guidance, a measure of earnings guidance momentum, is at its lowest level since 2019. The downbeat signal suggests that the profit expansion that the investors had been banking on may not be as swift as expected. There are plenty of reasons for companies to be wary, ranging from a war in West Asia to stubborn inflation to also a lack of clarity on the economy.